Hey, Sip&Talkers, welcome back. Great to have you with us again.
Hey, everyone.
Today, oh boy, we're diving into something huge. The absolute hottest topic, really shaking up everything, artificial intelligence.
Yeah, AI. It's everywhere.
But we're not just geeking out on the tech itself, right? We're talking money, power, influence. And those 7 names.
The big ones.
The Magnificent Seven. Yep. Apple, Microsoft, Google, Amazon, Meta, NVIDIA, and of course, Tesla.
Exactly. These aren't just companies anymore. They feel more like economic forces of nature, almost running the show for the U.S. stock market.
That's a good way to put it. You know, some people are calling them the modern dragons because they really are shaping how we're all going to live with AI.
Dragons, I like that.
Yeah. And it's not some far-off future thing. Think about Microsoft's Copilot helping you write emails, or Amazon's Bedrock underpinning new services, or Tesla's cars trying to drive themselves.
Full self-driving, yeah. Crazy stuff.
It tells you one thing loud and clear. AI is now. It's happening all around us right this second. And behind the scenes, it's this, well, frankly, insane investment race.
Right.
A huge scramble. That's what we really want to unpack for you today on Sip and Talk.
Right. Who's actually making bank from this and who's maybe, selling more of a dream right now? High potential, sure, but maybe high risk too.
We got to figure out, among these 7 giants, who has the strongest defense, the best moat, that thing protecting their future profits in AI.
And who might be getting a little ahead of themselves, maybe even getting swamped by the very wave they helped create. The speed is just incredible.
Definitely. And later on, we're going to really zoom in on 2 specific players. Amazon versus Tesla. Their strategies are just worlds apart.
Oh, yeah. The Cloud King, Amazon digging deep to defend its core turf, versus Tesla, running this massive real-world AI experiment on our roads. It's fascinating.
Absolutely. So grab your drink, settle in. We're about to crack open the black box of these AI 7 wars. Let's see if we can figure out who's truly steering the ship towards the future. Okay, so let's start with just how big these companies are. We hear Magnificent Seven thrown around all the time. But for someone listening, maybe managing their own investments or just trying to understand the economy, why do these specific 7 matter so much? Like, fundamentally?
Well, fundamentally, it's because they're not just in the market anymore. They pretty much are the market, or at least the market's main engine.
A main engine, huh?
Get this. As of late 2025, these 7 companies together make up something like 31% of the S&P 500's total market value.
31%. From just 7 companies.
31%, yeah. I mean, that's a level of concentration we haven't really seen in decades. You'd have to go back to, like, the Nifty 50 era in the 70s.
Wow. Okay, so if you have a 401k or any kind of index fund, which, let's face it, millions of people do.
Yeah. Right. Your retirement savings, your investments, their performance is basically tied directly to how these 7 are doing. It's unavoidable.
So a downturn for them isn't just a ripple. It's a potential tidal wave for the whole market.
Exactly. That concentration creates, a certain systemic risk. But on the flip side, it also shows where the success is coming from. They're not just big. They are driving almost all the growth.
How much growth are we talking?
Okay, so in 2025, these 7 firms were responsible for over 70% of the S&P 500's earnings per share growth.
70%, just the 7 of them.
70% of the new profit generated by the top 500 U.S. companies. EPS, earnings per share, that's a key measure of profitability. So yeah, they are absolutely the growth engine right now, no question.
And that growth, that confidence, it's fueling this massive spending spree, right? The capital expenditure arms race, as people are calling it, CapEx.
Oh, completely. CapEx, that's the money companies spend on the big stuff, the long-term assets, data centers, specialized machinery, servers. Not just day-to-day running costs, and the AI CapEx numbers are just mind-blowing.
Lay it on us. How mind-blowing.
The Magnificent Seven's total AI infrastructure spending for 2025, it's projected to hit $320 billion.
$320 billion.
In 1 year.
Yep, and that's a huge jump, even from 2024, which was already high at $230 billion.
Yeah.
This isn't just tinkering, it's a fundamental rebuilding of the world's digital infrastructure.
Okay, so who's writing the biggest checks in that $320 billion pot? Is it spread evenly?
Not really, no. It's heavily weighted towards the cloud and data giants. You've got Meta, Amazon, Alphabet, that's Google, and Microsoft. Between just those 4, they account for over $250 billion of the total.
Wow. So 4 companies spending $250 billion. They are building the digital foundations for this AI economy. New massive data centers, faster networks, incredible cooling systems. It's almost like, the 19th century when the railroad barons were laying tracks across the country. They're building the essential pathways.
And the CEOs, the leaders of these companies, they're all in, right?
Yeah.
No hesitation.
Zero hesitation. It's actually remarkable how unified they are on this. The message from the top is clear. AI is a once-in-a-lifetime opportunity. You hear it again and again.
Any specific examples?
Sure. Andy Jassy at Amazon called it a lifetime opportunity, capitalized, Then you've got someone like Elon Musk at Tesla who goes even further. He talks about AI bringing sustainable abundance, driving costs for labor and energy down towards zero eventually.
Okay, sustainable abundance sounds optimistic, maybe a bit far out.
Maybe. But even if that utopian vision takes a while, the more immediate potential payoff seems big enough to justify these huge bets. Analysts are projecting AI could add something like $133 billion in new value to the global economy by 2030.
And the M7 are positioned to grab the lion's share of that $133 billion.
You bet they are, which kind of leads us to the next logical question. Where is all this money actually going? What are they buying? This helps us understand the different layers of the AI industry.
Right, the supply chain. Let's break that down. There are sort of three main levels, aren't there? Starting at the bottom. Level 1.
Level 1, AI infrastructure, the hardware. This is where the money is flowing fastest right now. It's the famous picks and shovels play in the gold rush.
So the actual computer chips.
Exactly. High-end GPUs, graphics processing units, mostly from NVIDIA, the massive data centers themselves, the super advanced packaging needed to connect all these powerful chips. Companies here, like NVIDIA, are seeing insane growth because basically everyone else needs their stuff.
Okay, so that's the foundation. What's level 2?
Level 2 is the cloud platform, the enabler layer. This is where that raw computing power gets turned into something businesses can actually use.
Like Microsoft's Copilot or Amazon Bedrock, Google Gemini.
Precisely. These platforms take the hardware muscle from level 1 and add software, tools, APIs. They're the main entry point for big companies wanting to use AI. And it's a good business model. They already have strong cash flow from their cloud services, and now they add this AI growth on top. Relatively stable, high-margin stuff.
Makes sense. And then level 3.
Level 3 is the application layer. This is where AI gets integrated directly into the things we use every day or into specialized business software SaaS, software as a service.
So like Adobe putting AI into Photoshop, or Apple building Apple Intelligence into iPhones, or Tesla's full self-driving in the car.
Exactly. The potential here for capturing value directly from users or specific industries is enormous long-term,
right?
But it can be more volatile in the short term. You need to prove it works in the real world, get people to adopt it, The payoff isn't always immediate.
Okay, that 3-level framework hardware platform application, that's super helpful. Now we can kind of slot the Magnificent 7 into those categories and see how each one's trying to build its own advantage, its own moat. Let's start with the undisputed king of level 1, the hardware guy.
Has to be NVIDIA. No contest right now. Their CEO, Jensen Huang, isn't shy about it either. He calls AI the new industrial revolution.
And their valuation reflects that, right? It's just exploded.
Exploded is an understatement. They blew past a $5 trillion market cap. $5 trillion. And get this.
Yeah.
Their data center business, which is basically selling these high-powered AI GPUs, now makes up over 80% of their entire revenue.
80%. Wow. So they're not really a gaming graphics card company anymore. They are a pure AI infrastructure company.
Pretty much. It's an incredible transformation.
Is that risky?
Yeah.
Being so reliant on one thing, even if it's booming.
Right now, it looks like sheer dominance. Think about it. Every other company in the M7, plus countless others, has to buy their chips. They're selling the essential tool. They win, regardless of whether Microsoft's AI beats Google's AI.
They're selling the picks and shovels to all the miners.
Exactly that analogy. And they're not standing still. They're launching their next-gen chip architecture called Blackwell, rolling out in 2025 and 2026. That should keep them ahead of the performance curve for a while.
Okay, let's move up to level 2, the cloud and productivity rulers. First up, the giant from Redmond, Microsoft.
Microsoft sees AI fundamentally as the productivity revolution, especially for businesses. Their strategy is very pragmatic, very focused, deep partnership with OpenAI, the creators of ChatGPT.
Right, they poured billions into OpenAI.
They did. And they're leveraging their huge Azure cloud platform. They pumped around $80 billion in CapEx into Azure recently to deliver AI services mainly through Copilot, directly to their massive base of existing enterprise customers.
Yeah, Copilot seems like such a smart play because it plugs right into Word, Excel, Outlook, tools people already use constantly.
That's their genius, their distribution mode. They don't need to convince businesses to adopt a whole new platform. They're just upgrading the tools they already pay for. And it's working. AI services are expected to drive about 20% of Azure's growth in 2025.
20% is significant. Shows they're actually making money from AI quickly.
Yeah, turning that CapEx into high-margin subscription revenue, that's the goal.
Okay, now let's compare that to Alphabet or Google. How's their approach different? They also see AI as a massive opportunity, right?
Oh, absolutely. Google calls it the biggest opportunity. And they're tackling the whole spectrum from basic research with their Gemini models all the way to integrating AI into search, ads, YouTube, their core consumer products.
And they're building their own hardware too, aren't they? The TPUs?
Right. Tensor processing units. That's a key difference. While Microsoft is heavily partnered with OpenAI and buying lots of NVIDIA GPUs, Google is investing heavily around $75 billion in CapEx on building out its own data centers and designing its own specialized AI chips, the TPUs.
So they're trying to avoid the NVIDIA tax, basically. Engineer their way around it.
That's a big part of the bet. They believe that tightly integrating their own custom hardware and software, like Gemini running on TPUs, will give them better performance and cost efficiency in the long run.
And how's that playing out in their cloud business?
It's a battle. AI is expected to contribute over 30% of Google Cloud's growth. So they're definitely gaining traction, fighting Microsoft for every enterprise deal. Plus, they have that incredible data advantage from search and YouTube to train their models. That's huge.
Okay, moving to category 3, the consumer and data ecosystems. Let's talk about Meta Platforms, Facebook, and Instagram's parent company.
Meta's AI focus is laser sharp, driving user engagement on their platforms and making their advertising much, much more precise. Their killer advantage.
The sheer amount of it, right?
Unbelievable amounts. They have data from 3.5 billion users interacting daily. Think photos, videos, comments, likes. They use all that human behavior data to train their AI models, like their big language model, Llama.
Yeah, Llama. They made that open source, which seemed kind of surprising. Why give it away?
It's a strategic play. By making Llama open source, they encourage developers everywhere to use it, build on it, find flaws. It accelerates development and positions Meta as a leader in AI research, which ultimately helps them build better internal tools for ads and engagement. And they're backing this with serious cash, $70 to $72 billion in CapEx for the infrastructure.
And the payoff for them is better ads, more clicks.
Essentially, yeah. Even small improvements matter at their scale. If AI-powered ad tools can increase user retention by just 5%, that translates into billions of dollars in extra advertising revenue. It's incremental, but massive.
Right. Finally, in this category, the perennial outlier, Apple. Their approach always seems different.
Always. Apple's playing the privacy-first card with AI. Their big push is Apple Intelligence, which is designed to run primarily on your device, on the iPhone, the Mac, rather than in the cloud.
Why that approach?
Two main reasons. One, it reduces their dependence on cloud providers like Amazon or Google. Two, and this is key for their brand, it enhances user privacy. If the AI processing happens locally, your personal data doesn't need to be sent off to some server farm. It makes their ecosystem stickier.
And that explains why their CapEx is lower. Around $10 billion. They're not building giant data centers for this.
Exactly. They're not trying to compete with AWS on raw cloud infrastructure. Their strategy is to embed the intelligence into the hardware they sell. Success for them means selling more iPhones, more Macs, more iPads. They expect these AI features to boost hardware sales by 10–15%.
So for Apple, AI is a feature that justifies a premium price for the device, not really a separate service they sell.
That's the model. High-margin hardware enhanced by increasingly sophisticated on-device AI.
Okay, let's really dig into this comparison we promised. Amazon versus Tesla. Two radically different bets on how AI shapes the future. Let's start with the cloud giant, the utility provider, Amazon.
Amazon's whole philosophy is driven by AWS, their cloud division. For them, AI is a competitive necessity. They aren't just offering a place to run AI models. They want to be the essential full-stack provider, from the chips to the training tools to the platform itself, like Bedrock, where companies deploy the models.
And the investment reflects that ambition. You mentioned their CapEx earlier, maybe $100 billion for 2025? That's way more than anyone else, even the other cloud players.
It's truly utility scale. We're talking absolutely enormous infrastructure projects. Like, take Project Rainier they're building in Indiana. It's an $11 billion AI data center park.
$11 billion for one park.
Yeah, and it's projected to need 2.2 gigawatts of power.
2.2 gigawatts. What does that even mean?
Okay, for context, that's roughly enough electricity to power like 1.6 million typical American homes, all for one data center complex focused on training huge AI models. And they're also investing heavily in the models themselves, putting $8 billion into Anthropic, the company behind the Claude AI model, to make sure they have a top-tier competitor to OpenAI's models deeply integrated into AWS.
So they're building the stadium and signing the star players. This sounds like they're fiercely defending their cloud business, trying to protect those profit margins.
That is absolutely the core strategy. And a key part of that defense is developing their own silicon, their own chips. This is crucial.
Right. You mentioned Trainium and Inferentia.
Exactly. Trainium is custom designed for the really expensive part,
right,
training these massive AI models. Inferentia is designed for the other side, running the models efficiently once they're trained, what's called inference.
And the goal there is to rely less on NVIDIA.
Precisely. It's about reducing their dependency on outside suppliers, cutting their own costs, and ultimately boosting those AWS profit margins. Control your supply chain, control your destiny, basically.
Makes total sense. What about inside Amazon's own massive operations, like their warehouses and delivery networks? Is AI changing things there?
Oh, significantly. The efficiency gains are already showing up. Projections suggest AI automation could help Amazon avoid hiring around 600,000 warehouse and logistics workers by 2033.
Avoid hiring, not necessarily replacing current workers.
That's the framing, yeah. It's about enabling growth without adding headcount at the same rate, shifting towards safer, more automated systems that can run around the clock. Andy Jassy, the CEO, has been pretty upfront about the costs, though. He's acknowledged that AWS profit margins have dipped temporarily down to around 35% because of these massive AI investments.
35% still sounds pretty good.
It is good, but it was higher. His point is you have to accept that temporary dip, invest heavily now to secure dominance for the long haul. Spend now to own the future.
Okay, a very deliberate, infrastructure-heavy strategy. Now, let's pivot completely. Let's talk about the wild card. Tesla, the real-world AI integrator. This feels like a totally different game.
It is. It's arguably the highest risk, but also potentially the highest reward AI play among all the Magnificent Seven. Tesla's core belief, driven by Musk, is that AI will eventually account for something like 80% of the company's total value.
80%.
Yeah.
So the cars are just a stepping stone.
In this vision, yes. They see themselves transitioning from being primarily an electric vehicle maker, which is capital-intensive, relatively lower margin, into a high-margin company focused on AI software, services, and robotics. The cars are essentially data-gathering machines on wheels.
And that data is their big advantage, right? The
Yes.
driving data.
Undeniably. Tesla's fleet has logged over 6 billion miles with autopilot engaged. 6 billion. That is a colossal lead in real-world driving data, capturing all sorts of weird edge cases and complex scenarios you need to train a truly capable self-driving system. It's very hard for anyone else to replicate that scale.
And then there's the robot, Optimus. Musk seems to think this is even bigger than the cars.
He calls Optimus the ultimate AI application. The idea is to take the AI learning from driving in the complex real world and apply it to a humanoid robot that can perform tasks.
What are the actual plans for Optimus right now? Is it real?
It's real, but early stages. They have ambitious targets, aiming to produce 5,000 to 10,000 Optimus units in 2025. The estimated cost is around $20,000 to $30,000 per robot. Initially, they plan to use them internally in their own factories.
Testing them out themselves first.
Right. But analysts are watching closely. Some predict the market for humanoid robots could reach over $200 billion by 2030, maybe $218 billion. And if Tesla cracks the code first,
They could dominate another massive market. But what about their big AI computer, Dojo? We heard a lot about that. Is that still a plan?
that's where things get interesting and show the volatility. Tesla invested heavily, about $1.8 billion, into building Dojo, this custom supercomputer specifically for training their AI models, especially FSD.
Okay.
But recent reports suggest they're actually adjusting that strategy, maybe scaling back the purely centralized Dojo approach.
Scaling back. Why?
It seems they might be shifting focus more towards developing really powerful, efficient chips that go inside the car itself for inference, for making decisions in real time rather than relying solely on massive centralized training.
What does that shift tell us?
It suggests that building and running these gigantic AI training systems is incredibly expensive and power-hungry, maybe even more than they anticipated. And it highlights that the real challenge might be making the AI run efficiently and safely on the device in the car or the robot. It's a sign of the strategic risks and the immense costs involved.
So you add that strategic uncertainty to the constant regulatory scrutiny they face, especially around FSD safety from agencies like the NHTSA.
Exactly. It paints a picture of massive potential, yes, but also significant ongoing risk. Tesla remains the most volatile, the biggest gamble within the Magnificent Seven.
You know, it's easy to get caught up in the billions of dollars, the capex, the stock price, but we need to step back and think about the bigger picture here, the actual stakes. Some of the warnings coming from the very people who built this technology are, well, they're pretty sobering. Let's start with Geoffrey Hinton, often called the godfather of AI.
Yeah, Hinton's perspective is crucial. He was fundamental to developing the deep learning techniques that underpin modern AI. And now he's sounding a serious alarm, not just about jobs, but about existential risks.
Existential risk. How does he frame it?
He uses this striking analogy. He says we should think of advanced AI, the kind that might arrive within a decade or so, as being like an alien invasion fleet. Something potentially far smarter, far more capable than us.
An alien invasion fleet? Wow, that's stark.
It is. He argues it's moved beyond a purely philosophical question into a genuine security concern. And his main worry is that our current ways of thinking about control, like a manager controlling an employee, just won't work when the thing you're trying to control is vastly more intelligent than you are.
Right, the idea that you can't just fire a superintelligence or pull the plug if it's woven into everything.
Exactly. The standard corporate model breaks down. So he proposes this really provocative alternative. He calls it the baby controls mother model.
Okay, baby controls mother. We need to unpack that one. What does he mean?
It's a fascinating thought experiment based on evolution. His point is, if raw intelligence isn't going to be our advantage anymore, we need another way to ensure our survival. He looks at how a human infant, which is obviously far less intelligent and powerful than its mother, still manages to control the mother's behavior.
Through attachment, crying, making the mother want to care for it.
Precisely. Through deep-seated evolutionary drives for care, attachment, protection. Hinton suggests that for humanity to navigate this transition safely, we might need to engineer AI systems that have a similar intrinsic motivation to care for us. We have to accept, in his words, we are the baby, they are the mother. We need to design AIs that are fundamentally attached to human well-being.
That is deeply unsettling, but also strangely logical. Does he think the companies actually building this stuff, the M7, are prioritizing this kind of safety?
He's worried they aren't, not enough anyway. He sees a dangerous competition dynamic. While some companies, maybe like Google or Anthropic, which Amazon invested in, seem to be taking safety more seriously, the overall race for market share often pushes caution aside.
The pressure to deploy faster, be first.
Right. He's suggested that companies like Meta might be less focused on the long-term safety aspects compared to others, and he's even expressed concern that OpenAI's original commitment to responsible development might be weakening under commercial pressure. Getting the next version of Llama or Gemini out the door can sometimes feel more urgent than the slow, hard work of ensuring alignment and safety.
Okay, let's connect this back to the economics. This $320 billion tsunami of capex from the M7. What does Hinton think that means for regular workers?
For jobs. His view here is pretty bleak, and it cuts against the usual narrative that technology always creates more jobs than it destroys. He's quite blunt. The fundamental purpose of this massive AI investment from a corporate perspective is to automate work, manual work, repetitive work, and now, increasingly, cognitive work in order to capture enormous productivity gains and profits.
And he doesn't buy the idea that enough new, better jobs will appear quickly enough.
He's deeply skeptical. He doubts that new roles will emerge fast enough to compensate for the scale and speed of displacement that advanced AI could cause.
Which leads directly to the inequality issue, right? If productivity skyrockets, but the gains go mainly to the owners of the AI.
That's exactly his concern. He foresees a scenario where, quote, people like Musk becoming richer while many people lose their jobs. The wealth generated by AI could become incredibly concentrated, widening the gap between capital and labor. Even Musk, for all his optimism about abundance, has called the pace of AI development a supersonic tsunami, acknowledging the immense disruption.
Okay, that's a pretty dark view. Let's bring in another perspective from someone who's built one of these empires, Jeff Bezos. How does he see this AI boom?
Bezos offers a really useful historical lens. He makes a distinction between different kinds of economic bubbles. He argues the AI boom isn't like, say, the 2008 housing bubble, which was a financial bubble that just left destruction in its wake.
Okay, so what kind is it then?
He sees it as an industrial bubble. Think of the railway mania in the 1800s, or the dot-com boom around 2000. Yes, lots of individual companies went bust, lots of investment was wasted, in a sense, but
they left behind useful infrastructure.
Yeah.
Tracks, fiber optic cables.
Exactly. Even when the bubble pops, you're left with something valuable, something foundational that enables future growth. That's how Bezos views this AI spending. Even if some specific AI ventures fail, the data centers, the chips, the software platforms being built with this $320 billion capex will form the bedrock of the next economic era.
So the massive spending makes sense from that long-term foundational perspective.
Right. It fits his core philosophy. Invest heavily in things customers will always want: lower prices, better selection, faster delivery. AI is just a powerful new tool to deliver on those fundamental, unchanging desires more effectively.
And that leads to his more philosophical point, doesn't it? About what humans are good for when machines get really smart.
It does. His argument is that as AI takes over more and more purely intellectual tasks, the things that make us uniquely human become more valuable. What can machines not replicate easily?
Things like creativity, empathy, love.
Exactly. Love, compassion, creativity. And he specifically highlights kindness. He often tells a story from his childhood where his grandfather told him, Jeff, one day you'll understand that it's harder to be kind than clever.
Kindness is harder than smarts.
Yeah. When intelligence becomes a cheap commodity produced by machines, maybe kindness, genuine human connection becomes the premium skill, the thing society truly needs.
Okay, this has been a huge tour, technology, finance, philosophy. Let's try to bring it back down to earth for our listeners. Thinking about the M7 and their AI strategies as we head into 2026, what's the main takeaway? What's the investment climate like right now?
I think the big summary is that 2025 was really the year of infrastructure competition.
Yeah.
Everyone was racing to build. Now the market seems to be shifting. We're moving away from just the exciting storytelling phase, which boosted a lot of smaller AI stocks that maybe didn't have real products yet, towards demanding proof. Show me the money. It's about cash flow verification.
Investors want to see actual returns on that $320 billion they're spending.
Absolutely. Where is the revenue? Where are the profits starting to show up?
So based on our breakdown, the supply chain levels, the strategies, who looks like the, let's say, safer bets right now for generating that immediate cash flow from AI?
Well, looking at where the money flows most directly, you'd have to point to the foundational layers first. Level 1, the hardware, especially NVIDIA. They benefit immediately and directly from everyone else's spending. That $320 billion capex, a huge chunk goes straight to buying their chips. Demand is just off the charts.
Okay, so the picks and shovels provider is in a strong position. Who else?
Then you look at level 2, the platform providers, primarily Microsoft and Amazon. They are positioned to capture revenue quickly through selling high-margin AI subscription services like Copilot and Bedrock to their massive existing customer bases in the enterprise world.
They have the channels to sell into immediately.
Right. For them, the path to monetization is clearer, maybe less speculative than some of the pure application plays right now.
And for Amazon specifically, you mentioned their margins dipped due to investment. What's the key thing investors should be watching to see if their big bet is paying off?
The absolute focus needs to be on AWS profitability. Can the revenue from their new AI services, from Bedrock, from customers using their custom Trainium and Inferentia chips, actually start to lift those cloud profit margins back up sustainably above that 35% level?
If they can do that, it proves the investment was worth it.
Exactly. If they pull it off, it solidifies their dominance and shows that massive capex translated into an even stronger, higher margin business. That's the key test.
Okay, and then we have the big uncertainty factor. The outlier.
Yeah, that's Tesla. The potential upside is obviously enormous, revolutionizing transportation, maybe creating a whole new robotics industry. But the risks are just as high, if not higher.
The regulatory hurdles around FSD aren't going away.
Not at all. That remains a major headwind. And those strategic shifts we talked about, like adjusting the Dojo supercomputer plan, show they're still navigating very complex, very expensive technical challenges. It's definitely the highest volatility play among the 7. Huge potential reward, but also significant near-term risk.
Got it. Finally, are there any hidden risks lurking out there? Things that could trip up all of the Magnificent 7, even the seemingly solid ones like Microsoft or Amazon?
Definitely. 2 big ones come to mind that maybe don't get enough attention amidst all the AI hype. First, energy and power.
Right. These things need a ton of electricity.
A monumental amount. Training these models is energy intensive, but running them 24/7, the inference part, might be even more demanding in the long run. Remember Amazon's Project Rainier needing 2.2 gigawatts? That's not an anomaly, it's the future. This creates huge hidden costs, limits where you can even build data centers based on power availability, and raises massive environmental and social questions.
The ESG angle, yeah. What's the second big risk?
Geopolitics and regulation, this is always simmering. U.S.-China tensions, export controls on advanced chips that directly impacts NVIDIA and the supply chain for everyone else. And then you have new regulations popping up, like the EU's AI Act. These could seriously restrict how companies, especially consumer-facing ones like Meta and Google, can use data for training their models.
Which could directly undermine their core competitive advantage, their data moats.
Precisely. So power constraints and unpredictable regulation, those are major clouds hanging over the entire M7 landscape, regardless of individual strategy.
Ooh, okay. We've covered a lot of ground, the money, the tech, the strategies, even the philosophy. Hopefully this whole conversation gives you, our listeners, a clearer picture to navigate this AI storm. It's certainly reshaping everything.
Yeah, and just to be clear, our goal here on Sip and Talk was really just to lay out the facts, the strategies, the different perspectives as we see them. We're not endorsing any company, definitely not giving investment advice. This is all about sharing information and hopefully sparking some independent thinking.
Absolutely. The data doesn't lie, though this AI revolution is moving incredibly fast. But it leaves us with that big question, maybe the biggest one, raised implicitly by both Bezos and Hinton. Well, if Bezos is right that AI makes intelligence cheap and abundant, like an industrial commodity, and if Hinton is right that AI might soon surpass our own intelligence, then how much should we as humans really focus on just being smart anymore versus focusing our energy, our development, our societal values on being kind? On cultivating those things machines supposedly can't replicate.
Kindness is harder than smarts. That might just be the ultimate human value proposition in the age of AI.
Something to think about.
Yeah.
All right, that's all the time we have for today's Sip and Talk. Thanks so much for tuning in.
Yeah, thanks everyone. Make sure you subscribe to the show so you don't miss our next one.
Oh, and definitely check out our old friend Mitchie's YouTube channel. It's called Mickytolife. He's got some hilarious memes, and his latest travel vlogs are always fun. Highly recommend.
Good stuff over there.
All right, we'll catch you next time on Sip and Talk.